The three pillars of financial independence are earn more, spend less, save that difference, and invest it for long-term growth. Everyone around you has an opinion about what to invest in. Bitcoin, property, gold, AI. The best investment is something that has decent returns that you can stick with for the longest time. With just 60K invested, we ended up with over $1 million. This is the magic of compounding. This is great if you have 60K to start with, but what if I don't have anything at all? I got to cover. For the last 2 centuries, the stock market average returns have been around 10%. Yeah, great, but the stock market is risky. I don't understand nothing about the stock market. Some people lost their money in the stock market. I don't know which stock to pick. This is my favorite one. I prefer to give my money to a professional fund manager. The last one, I don't have time. I'd rather have someone do this for me. 90% of financial advisors are actually sales brokers. That is in the US, which is highly regulated. In the whole Middle East, I'm not just talking about the UAE. I could probably count the number of good financial advisors on one hand. How do we invest in these ETFs? In 3 easy steps. Step number 1, now, which ETFs to choose? There are thousands of them. The basic rule for choosing an ETF is super simple. Another thing, anyone investing here in ETFs such as SPY, QQQ, VOO, VTI, well, I have some bad news for you. Now, here's how to build an ETF portfolio that will beat 99% of investment professionals. All you need is how to invest and achieve financial independence if you live in the Middle East. This is part 2 of an event recorded live at Fairgreen International School in Dubai and brought to you by Simply FI, a Facebook group and community about ETF investing and financial independence. This is a 40-minute masterclass on investing for complete beginners, so I hope you get great value out of it. Okay, so thanks again one more time for being here. I know this is a Sunday morning, so really thanks again for taking the time to come here on a Sunday morning to listen to Blair and I babble about financial independence. So after you guys have heard about the why from there when it comes to why financial independence is important, in this part of the presentation we're going to talk about how to invest to achieve financial independence. But first, who's this guy basically to even lecture me about financial independence? So first off, I'm not a financial advisor myself. I'm not a financial professional. I'm just a regular dude. I worked my entire life for almost 30 years in IT. So I'm an IT professional. I'm into consulting, IT consulting and professional services. So absolutely nothing to do with investing or finance for that matter. In fact, and my friends here in the room know this about me, I literally struggle when it comes to splitting a simple restaurant bill. So if I could do this, then any one of you guys can do it. So it's not really rocket science. Now, many know me through Simply FI, which is a Facebook group about financial independence. Maybe some have seen some of the articles I've been featured in, whether it's in the national or Gulf News. Some of you might have come across my YouTube channel or blog, which is Wise Investor Mid East, which is basically another platform where I share everything I've learned about financial independence and how to invest for financial independence. But my story started back in 2014. And in 2014, I lost my job. And for anyone who's been through this, you probably know how devastating that is, right? So the stress, the uncertainty about tomorrow. So that was me. But as the saying goes, when you lose, don't lose the lesson. So this actually taught me a couple of things. So I was totally stressed because I lost my job. And then I realized that first, my savings were not enough and that I had zero plan to retire. And then I also realized that I was totally dependent on my job or on my income. So I was living paycheck to paycheck. And when the paychecks stopped coming in, I was in trouble. So I realized I was actually this guy. I realized that since I was this guy running on a hamster wheel, I needed to find my way out. And being an avid reader, I started researching, reading. I ended up reading more than 30 books on personal finance. and investing. And I'm not saying that you need to do any of this because everything I've learned, I'm going to share with you guys in the next maybe 20-ish minutes. I came across the concept of financial independence. And I'm not going to talk again about financial independence because Blair did an excellent job covering this. But the three pillars of financial independence are earn more, spend less. So in other terms, live below your means. And most importantly, save that difference and invest it for long-term growth. And this is not a one-off thing. You have to do this consistently, regularly, month after month after month. Great, invest. But how do I invest? And what do I invest in? And by the way, everyone around you, even in this room, everyone has an opinion about what to invest in. Invest in gold, invest in AI. AI is the latest, the latest craze these days. But I don't know about you guys, but I didn't want to leave my investment for luck. I wanted to have something consistent, reliable that I can really, because this is my life savings that we're talking about here. And in fact, I'm going to put up this quote for Morgan Housel, which is the best-selling author of The Psychology of Money. And I'm going to paraphrase it in here. Morgan Housel said that good investing is not about making a killing in the stock market or investing in something that kind of triples overnight or that 10x's in a week time. Because anything that does that is going to most probably be a fluke. And this is not something that is repeatable. So the best investment is something that has, I would say, decent returns that you can stick with for the longest time. And this is when compounding runs wild. And what is compounding? Let me show you how compounding works with a simple animation. Let's say that I invest my money, which is that gray block you see over there, in something that returns, say, for the sake of argument, 10% per year. So after the first period, so I got my initial lump sum plus any interest or any growth or any returns I got on top of that, which is the green part on top. On the next period, I invest the same thing. So I keep the money. I don't withdraw the money. I keep it in. And the following year is going to be the same. And I keep doing this over and over again. Over time, the money I got will trump the initial, trump as in the verb, not the person. So it will trump my initial investment. So this is an exponential growth for the money I've invested. Let me show you this with an example. Let's say I've invested $60,000 or dirhams or pounds, doesn't really matter, in something that gets me, let's say, 10% returns per year. By the end of the first year, I will get 10% of 60K, which is what? 6,000. Let me expand this example. Let's say that I'm gonna keep that money invested, and each year I'm gonna withdraw my interest or my returns. So by the end of each year, I'm withdrawing 6K, and over 30 years, I would have withdrawn 6K times 30, that is 180K. Awesome. So I invested 60K, and over 30 years, I got 180, which is not bad at all. Now, let's see what happens if instead of withdrawing the money, I will keep my money invested all the time so that it actually compounds with all those years. Now, seriously, Elie, on a Sunday morning, tables and numbers, bear with me for the next minute. I promise to keep it super simple. This is my 60K I started with. So I started with 60K. It's the exact same 60K, but the only difference here is instead of withdrawing the money, I'm keeping my interest or my returns invested all the time. So by the end of the first year, I'm getting 10% of that, which is what? 6K, 6,000, right? However, on the second year, instead of starting with 60K, now I'm adding the 6,000 I got on top of my 60K. So I'm starting on the end of the first year, I'm starting with 66K, right? Now let's see what happens the second year. I'm getting 10% on my 66K, which is how much? 6,600. I'm gonna stop right here. So I'm not gonna bore you with all the details. Now, can anyone guess? And we're gonna keep doing this year after year after year after year. Would you wanna guess how much I will end up with after 30 years? with just 60K invested, with nothing, with not a single dollar added on top of that. Would anyone want to guess? 800? 300 something. 300 you said? Okay. So ladies and gentlemen, this is what we'll end up with after 30 years. So there you have it. We ended up with over $1 million, starting with just $60,000. So this is the magic of compounding. Now why? It's so hard to guess. Why? Because it's not linear, it's exponential. And our brains, right? So our brains think linear. So this is exponential. So this is why it's sometimes hard to guess how much we'll end up with after 30 years. This is great if you have 60K to start with. But what if I don't have anything at all? I got you covered. So I'm gonna do the same simulation with compounding, starting with $0, with the same return rate of 10% per year and over 30 years. So I started with zero, and over 30 years, I ended up with, by the way, over 30 years, I would have contributed 500 times 12 months times 30 years. So I've contributed a total of 180K, which is a little bit above my 60K, but this is something that I've contributed over 30 years. And I will end up with well over $1.1 million. So $500 per month, which is probably less than 2,000 dirham, 1,800 and something, I guess. And I ended up with well over $1.1 million. So this, ladies and gentlemen, is the magic power of compounding. Compounding is so incredibly powerful that Einstein is believed to have said that it is the eighth wonder of the world. All right, so there are three aspects or three factors that contribute to how our money compounds over time. So number one is the amount I'm investing. So it could be the initial lump sum or my monthly contributions, or maybe both. Maybe I could start with some lump sum and then contribute some money on top of that. Then we have the time. So the longer the duration, the more exponential the chart gets, and our return rate. And getting back to what Mr. Housel mentioned earlier, my return rate doesn't have to be really astronomical. A reasonable 10% return will get me to that $1 million in 30 years, starting with zero, right? So again, it's not about making a killing, it's about getting decent returns that we can stick with for the longest time. And this is why we like the stock market, because for the last 150 or 200, so nearly for the last 2 centuries, the stock market average returns have been around 10%. So again, it's not 10% every single year, as you guys have seen in Blair's chart. So in some cases, it could be plus 25%. In some other cases, it could be negative 40%. But over the years, the average is pretty much 10%. So it's not really a smooth ride. It's more of a bumpy ride. And it looks pretty much what you can see here. And by the way, this is the exact simulation for the exact 60,000 I started with 30 years ago. And 30 years later, I've reached something well above $1.1 million. So these are actual numbers. So I've shown you these are real numbers and real data from the stock market. But I hear some of you saying that, yeah, great, but the stock market is risky, right? And by the way, that was probably me a few years ago. Or I don't understand nothing about the stock market. Spoiler alert, I don't understand anything about the stock market anyway. So you're not the only one. Or some people lost their money in the stock market, and we're going to see why in a second. Or maybe I don't know which stock to pick or what company to choose. Or, this is my favorite one, I prefer to give my money to a professional fund manager or a professional financial firm, and they will handle my money or they will invest my money. And that was me probably several years ago when I handed over my money to a financial firm, 3 of them to be more accurate, because I was totally naive back then and I thought that these guys knew what they were doing, right? But we're gonna see in a second that these guys have no clue. Maybe they do, but the results speak otherwise. The last one, I don't have time. I'd rather have someone do this for me. Again, that was me several years ago. So let's do some myth busting. Why some people lose money in the stock market? Warren Buffett says that the three main enemies or the two main enemies of the investor are fees and emotions. So in other terms, fees, fear, and greed. Again, this is as per 200 years of stock market history. The stock market goes up over the long term. But like you can see in here, those red circles is where the stock market did something really funny. So there was, these were actually crashes in the stock market. Now, for someone who is investing and who goes through these, I would say, crashes, it's totally normal to panic. And those who have panicked and sold their money or sold their stocks and exited the market, they lost their money. Because it's very easy to get carried away with the emotions, like Blair mentioned earlier. But if we know the facts that over the last 200 years, the stock market has always been on an upwards trajectory. So you don't have to really get scared from the stock market. Now, the destructive impact of fees. I don't want to get too technical here. All you need to understand from this chart is that the one on top, the green one, is basically the theoretical returns of the stock market, assuming you're not paying anything in fees. So again, I invested, let's say, $60K or whatever it is, and I ended up with over $1 million. So this is in the ideal world, assuming I'm not paying anything in fees. In reality, you would have to pay. There's no way around it. There are some fees to be paid. However, if you look at that blue line that grows very closely to that theoretical green line, so this is like if you're investing in something with very low fees, such as ETFs or index funds, like we mentioned earlier. However, if you invest with the professionals that are typically charging me 4% per year, well, what's 4% between friends, right? It's more like a waiter's tip. This is what I used to think. But in reality, these plans, these long-term saving plans that are sold by big name financial firms, insurance companies, etc. So instead of ending with $1 million, I'm getting after 30 years close to maybe 300K and some change. So where did that 700K or 680K disappear? They disappeared in fees, because fees also compound over time, just like the interest or just like the growth. So there you have it. Fees destroy your returns. Yeah, but you know what? Professionals are supposed to know what they're doing, right? So aren't they supposed to be getting us better or higher returns? In theory, maybe, but the reality is something totally different. So the facts suggest otherwise, because study after study after study have shown that the professionals are not any better than you and I in beating the market. So over 20 years, nearly maybe 5% of professionals manage to match the market. So we're not even talking about beating. So 5% manage to beat or match the market, while 95%, and these are people that have an army of analysts, they have their finger on the pulse of the economy. They have access to some information that you and I do not have access to, and yet 95% of them manage to fail to beat or match the market. Yeah, but what about those guys? Can't we just invest with them? Because since we know who these guys who have managed to beat the market, why don't we invest with them? Because there are some other studies that have showed us again that the 5% of these fund managers or professionals that manage to beat the market in a certain period fail to beat the market in the following periods. So which means this is just a fluke. This is just not. It's not really skills. So why would I want to invest with something that charges me 4% per year, which will surely underperform the market over the long term, as we have seen in the previous chart, while I could do this myself and get, the full returns of the market. So again, professionals do not manage to beat the market. Moreover, most financial advisors, I would say, actually, Tony Robbins says that 90% of financial advisors are actually sales brokers. That is in the US, which is highly regulated. In our region, in the Middle East, in the whole Middle East, I'm not just talking about the UAE, maybe, just maybe, you'll find, or I could probably count the number of good financial advisors on one hand. And I'm not exaggerating here. And probably I would still have a few fingers to spare. So it is really that rare to find good financial advisors in the Middle East. Plus, as J.L. Collins says, avoid investment advisors, because by the time you find a good one, you already know how to manage your own money. Plus, he also adds, I'm sure it's not here on the slide, but he also said that it's your money and no one will care for it better than you. So this is another thing to keep in mind. And for those who thought that it's too hard, I can't understand it. And if this guy standing here in front of you who struggles to split a restaurant bill can do it, then anyone can. And believe me when I say that. It's super simple. It's not complicated. You don't really have to look at those charts that you can see on YouTube or in the media, analyzing companies, analyzing returns and whatnot. It's super simple, and we'll show how in a minute. Warren Buffett, which is probably the most legendary investor that has ever walked the earth. So he said a low-cost index fund is the most sensible most sensible investment for most people. He also said, by periodically investing in an index fund, the know-nothing investor, so that is me and you, maybe you guys know better than I do, anyone, even those who don't know anything about the stock market, if they invest in index funds, they will be the vast majority of professionals. And we're talking about professionals that have, a team of full-time analysts doing nothing but analyzing the stock market and the financial markets and whatnot. Before we continue, if you're getting value out of this video, please let me know by hitting that like button on YouTube, because I'm on a mission to spread financial literacy and the simple rules of wealth we should have all learned in school. And feel free to share this video with your friends, family, or colleagues. Now back to our content. Okay, so let me pause for a second. What's an index fund? So first, what's a fund? A fund is simply, let's say, a basket or a pool of money. So it's a fund actually pools money from investors, that is you and me, and then it is managed by a certain manager, or it could be a financial firm, that will basically choose what companies to invest in and what to buy and what to sell, etc. So this is what the definition of a fund or a mutual fund, if you will. An index is just like the S&P 500, which represents the top 500 company in the US. But there are other indices that actually track the global stock market with thousands and thousands of companies. Not just the US, but the global stock market. An index fund is just like the fund we explained a second earlier. So it pulls money from people, but instead of being managed by a board of financial professionals that would earn an arm and a leg to manage that fund, it's managed by a computer or an algorithm, if you will. So basically, it simply invests your money in whatever the index is tracking. For example, if I invest in a S&P 500 index fund, my money is spread all over the 500 companies that make up that index. For example, the likes of Apple, Microsoft, Tesla, you name it, Johnson & Johnson, etc., etc. Now, what are the advantages of index funds? So first off, since there's no one to manage that fund for you, it's managed by a computer or an algorithm. So first, it's low fees. broadly diversified. So by investing in that basket, you automatically are investing in every single component of that basket, be it the 500 companies in the S&P 500 as an example, or the thousands of other companies in a global index or a global stock market index fund. Simplicity. You don't need to guess which company will do good or which company will do bad. You just own them all. But yeah, but Elie, isn't it better to just invest in the companies that will do well and avoid those who won't do well? Well, guess what? If the professionals cannot do it, do you really think that you and I will be able to, will we be able to do that? Absolutely not. It's impossible for anyone, even for the professionals, to guess which company will do better. And if those who are cherry picking the companies are not doing well compared to the broad market, you know what? Why don't we just stick with the broad market and just let it ride? And then, like we said, unbeatable long-term returns. Now, how do we as expats living in the UAE invest in index funds? This is through what we call ETFs. So what's an ETF? It's a fund that has an index, just like the index fund we just explained. It is traded, which means it could be bought or sold on a market, and that market is called the stock exchange or the stock marketplace, if you will. For example, the New York Stock Exchange or the London Stock Exchange. Now, how do we invest in these ETFs? In 3 easy steps. Step number 1, you just need to open a trading account or an investment account, if you will, with what we call a brokerage firm or a broker for short. So a broker is just like a bank. Think of a bank account that is just specialized in in trading in the stock market, right? Now, some of the banks do offer trading in ETFs, but I personally prefer to keep banks for banking, and I prefer to use stock brokers for investment. The next step is to simply fund your account, which in simple terms means transferring money from your bank account to your brokerage account or to your broker. And once you have your money in, it's just a matter of logging into your brokerage account and buying that ETF. For anyone who has used Amazon or Noon to buy some stuff online, trust me, you know you already have what it takes to invest. It's as simple. You just log into your account and you buy the ETF. How do we choose a broker? So basically, a broker needs to be something that is solid. It needs to have good reputation, because I wouldn't trust to put my money in something that would disappear overnight. These are the ones that I would trust. The first one is Interactive Brokers, which is a US-based broker. So basically, when you open an account with these guys, you need to transfer your money out of the UAE. So because these are offshore brokers. The other one is Swissquote, which is a Swiss broker. A third one is Swissquote Bank Europe, which also belongs to the same Swissquote group, but this one is based in Luxembourg. So it's a separate division of Swissquote with separate fees and legal structure. The fourth one is Saxo Bank, which is based in Denmark. And the last one is a local broker by the name of Sarwa. Now, Sarwa is a special type of broker in a sense that it's also a robo-advisor. And I don't have this covered in the slide, so I'm going to give you a quick overview of what a robo-advisor is, such as Sarwa. With the top 4, you have to open the account, fund it, and then you have to manually log on and buy your ETFs. With Sarwa, you have the option to let Sarwa do the heavy lifting for you, in the sense that you send your money there and they automatically invest your money in low-cost ETFs. Now, of course, if they charge a small fee for that, I think this is less than 1%, 0.8% or 0.5%, depending on the size of your portfolio, depending on how much money you're investing. But in a nutshell, it does everything for you. So for those of you who don't have the time, don't even want to learn or do it themselves, just open an account with Sarwa Invest and let Sarwa do the magic for you. You just need to pump money in and they do everything for you. And there you have, you're done for today. For those who would like to do it themselves, which is definitely more cost effective on the long run, to be fair, you would need to choose your own ETFs. Now, which ETFs to choose? There are thousands of them. The basic rule for choosing an ETF is super simple. You would want your ETF to be as broadly diversified as humanly possible. So, in a nutshell, I prefer to pick broadly diversified global ETFs, not the S&P 500. The S&P 500 is a great index, but I wouldn't put my money entirely in the US market. Although it has done great over the last, I don't know, 20 years or so, but still I would prefer to have my money basically diversified globally. This is why I prefer globally diversified ETFs and not something that invests exclusively in the US market. And then avoid sector or country specific ETFs. Even if it's the almighty S&P 500 or the almighty US market, I would rather prefer to keep my money globally diversified. Yeah, Elie, but what about the that specific ETF that tracks AI stocks? AI is the latest craze. No, don't do it. Yeah, but AI companies have done great over the last couple of years, right? But that doesn't mean that they will continue to do great for the next few years. Remember, we are investing for the future and not for the past. So therefore, do not pick promising sectors, because over time, there's something in finance known as reversion to the mean. Anything that goes up faster than the broad market at some point in time, whether it's sooner or later, it will basically go down and basically just follow the overall trend. So spare yourself those, don't pick any fancy stocks or don't pick any trending sectors, because over time you are highly unlikely to beat the market. Remember the professionals? If the professionals could make it, maybe you could, but these professionals cannot make it. So don't. So just be humble. Don't think that you can beat the market because nobody else, no one can, right? But Elie, you're full of it. I insist. I want to buy this ETF that specializes in AI stocks. Fine, if you really must scratch that itch, do so, but keep it limited to maybe 5% of your total investments. Don't go overboard. Another thing, anyone investing here in ETFs such as SPY, QQQ, VOO, VTI, well, I have some bad news for you. If you're not American, you're making a huge mistake. But don't feel bad about yourself, because I made the exact same mistake when I first started. These ETFs are all domiciled in the US, which means they are not suitable for non-US person. Why? Because A, you are paying 30% in withholding tax on those ETFs. So for any dividends, the broker will automatically deduce 30% of your dividends. But that's not the worst part. The worst part is if you pass away with more than $60K invested in these American or US domiciled ETFs, up to 40% of that money could be confiscated in what we call estate tax or inheritance tax. So you wouldn't want that. So imagine you have $1 million and then Uncle Sam comes in and say, "Oops, sorry, I'm gonna take 400K out of this $1 million pool." Anyone who's not American in the room, you guys are better off investing in Irish domiciled ETFs, and these are the exact same ETFs. Let's take the S&P 500 as an example. There's an S&P 500 ETF that is domiciled in Ireland that tracks the exact same 500 companies, or 503 to be more accurate. So it tracks the same 500 companies that are part of the S&P 500, but the ETF registration or legal registration is in Ireland. And Ireland is more tax friendly for us non-Americans. So please keep this in mind when choosing your ETFs. Now, here's how to build an ETF portfolio that will beat 99% of investment professionals. All you need is a global stock market ETF and a global bond market ETF. And for those who invest in a Sharia compliant way, you could pick a global Sukuk ETF, which is the Sharia compliant version of bonds, if you will. Examples of an ETF portfolio. So for non-Americans, VWRA is the Vanguard FTSE or FTSE All World. So this ETF has, I believe, close to 3,700 companies in it, including the US companies. Plus, they also include companies in Europe, in the UK, Japan, Middle East, you name it. So it's a real global ETF that has companies from all over the world. And by the way, you could notice the name UCITS or UCITS. This is your hint that this is an Irish domiciled ETF and not an American ETF. Because basically, for those who are reading the books, and by the way, just like I mentioned earlier, I started reading books, and in these books, all they mentioned is the US domiciled ETFs. So I made that mistake, and when I first started, I used to invest in US ETFs until I learned about the Irish counterparts. Americans, such as Blair, would invest in something like the VD, which is the Vanguard Total Stock Market ETF. And these two are pretty much similar. They perform pretty much the same. They own more or less the same stocks. Now, of course, VT has much more, but that's not really significant for us because they both perform pretty much similarly over the long term. Now, when it comes to picking bonds or a bond ETF, non-Americans would pick something like IGLA, which is the iShares Global Government Bonds, or AGGG, for example, the iShares Global Aggregate Bonds. Or for Americans, they could pick the BNW, which is the World Global Bonds that is domiciled in the US. These are just examples. There are many others, but these are, for those who have been following our Facebook group, you can see these names a lot in the group because these are the ones that we recommend. I'm not going to bore you with this. I included this just in case we have some discussion about the asset allocation. The asset allocation is how we split our pot between stocks and bonds. And as you can see here from this chart, it's a matter of picking a certain percentage of or keeping a certain percentage of your portfolio in stocks ETF and the remaining in or the other part of your portfolio in global bonds. Now, how much to keep in stocks versus how much to keep in bonds? So this boils down to your own risk tolerance. The higher the percentage of stocks, the higher your long-term returns would be. However, the more volatile your portfolio will be in the short term. So there is no right or wrong here, but generally speaking, most people that are, I would say, still in their 20s or 30s might want to invest in something like 80% stocks and 20% bonds. Some others, such as Blair, invest entirely in stocks until very recently. She started adding some bonds. So there's no right or wrong answer in here. But the idea is the more you have in stocks, the higher your expected long-term returns, but the higher your expected paper losses would be in the short term, as you can see in this chart. For example, if you're 100% in stocks, you could expect 10.2 average returns over the long term. But as you also have seen in that slide earlier, it could be up to 55% of returns in a single year, but it could be also negative 43 or a 43% loss in any given year. So imagine you have $100,000 and the next day you look at your portfolio and it's only 60. Not a lot of people have this kind of risk tolerance. So therefore, now by the way, this chart shows you the different expected returns, maximum, minimum, and average for different types of asset allocations, going all the way from 100% stocks all the way down to 0% stocks and 100% bonds. Now, we wouldn't recommend going below 50-50. 50-50 is as conservative as it gets. Because, if you go below 50%, the 4% withdrawal rule will not work anymore. I don't think I have time to cover this. Investing in ETFs is not just, picking one and hoping for the best. It's basically about following a certain framework. that I would like to call the easy to follow or ETF plan. So it goes like this. Pay off your credit card, like we said earlier, set up an emergency fund, develop or write down your investment plan, and then you open your investment account, and then that green part in here is the repetitive part. You transfer money, or you send money, or you fund your account, you buy your ETFs. And by the way, once a year, you might want to rebalance your portfolio, which simply means you have to maintain that balance between stocks and bonds, like we have seen earlier, according to your set objective. For example, if you choose 60% stocks and 40% bonds, you need to maintain this over time. And these big red blocks in here is like ignore the noise, ignore the financial news because this is all noise, and avoid common pitfalls such as panic selling or trying to time the market, etc. Now, again, I don't have time to go over this in more detail, but I have a video on YouTube that you can watch and basically learn in less than 6 minutes about this particular framework. Basically, I want you guys to go with these takeaways. Number one, set your target. Have some clarity about your FI number. Then live below your means because this is the main ingredient that will get you to financial independence. Invest regularly in a portfolio of low cost index funds. And last but not least, stay the course. So do this, and I promise you that you will end up with more money than you ever thought possible. So thank you very much. So this is how to invest in the stock market to achieve financial independence. But how much money do you need to become financially free? To find out, click or tap this video card on the screen. Or alternatively, click or tap this card for another video. Remember to subscribe if you haven't for more content like this. Thanks again for watching, and I'll catch you in the next one.